Hi everybody, and welcome back to chapter 19. In our first video, we will be discussing variable costing and analysis. Okay, as we look at the learning objectives here, we're going to describe how absorption costing can result in overproduction, a very key and important concept. And then we're going to apply the contribution margin ratio for business decisions. And then we're going to look at converting income under variable costing back to absorption costing basis. So we'll compute our unit cost under both absorption and variable costing. We'll prepare and analyze an income statement using absorption costing and using variable costing. And we'll determine our product selling price and analyze special orders using this information. All right, let's look at computing unit cost under both absorption and variable costing. Here we have two product costing methods. One, variable costing, includes direct material, direct labor, and variable overhead, where absorption costing includes the direct material, direct labor, and variable overhead, but also includes fixed overhead. Major difference. Absorption costing is required by GAAP for external reporting purposes, but it can result in misleading product cost information and poor managerial decisions. I have personally seen that, in fact, happen. All right, let's look at absorption costing. Absorption costing, I call it sometimes full absorption costing. That's our product costs. And as noted there, we have direct materials, direct labor, variable overhead, and fixed overhead. Whereas for variable costs, we include the fixed overhead in period expenses, whereas direct materials, direct labor, and variable costs are included in the product cost. That subtlety is very important in that we don't cost product costs until they're actually sold in cost of goods sold. So there's a delay in reporting product costs under absorption costing, and for that matter, variable costing. But the fixed overhead costs are period expenses, so there's no delay under variable costing. Okay, let's see how that works. Here we have some examples. Direct materials, $4 per unit. Direct labor, $8 per unit. Variable overhead, $3 per unit. Total fixed overhead, $600,000 per year. And the units that we produced was 60,000 units. Notice I emphasize the word produced here, per year. Okay, under full absorption costing, we have $25 per unit. That included taking the $600,000 per year in fixed overhead and dividing it by the 60,000 units that we produced to get $10 in fixed overhead. Okay, and so if we were doing product costs under variable costing, however, we will show these period costs of $600,000 expensed right away. Okay, so this nicely summarizes the costs associated under these two methods. Okay, now we'll prepare and analyze an income statement using absorption costing and using variable costing. And the same example that we just went through here, in year 1, year 2, and year 3, we're going to produce the same exact amount but the units sold are going to be considerably different than the units produced. In the first year, the units that we sold were what we produced, so there were no units in ending inventory. But in year 2, we sold less than we produced, and that gave us 20,000 units in ending inventory. But in the third year, we made up for that by selling 80,000 units, and now inventory is back to 0 units. Now that's going to have some very interesting effects on our income reported using full absorption costing. Let's take a look. Here, if the income produced is equal to the units sold, here, production, 60,000 pairs of ice skates, it looks like, and we sold 60,000 pairs. So in that case, absorption costing will equal variable costing. And how does that happen? Here's our 60,000 units at $40 a pair, and our full absorption costing was $25 times 60,000, which is 1.5 million. That gives us a gross profit of $900,000. Then we have our selling and administrative expenses on top of that, which was $320,000 here. So our net income, $580,000. Under a variable costing statement, we do this a little differently. The sales are the same at $2.4 million, but we break out variable costs, 60,000 units at $15, which is $900,000. And then we have our variable selling and administrative expenses, which is $2 per unit times 60,000 units. And that gives us $1,020,000 in total. So our contribution margin is $1,380,000. Then our fixed expenses, we have fixed overhead at $600,000. And we also had fixed selling and administrative expenses of $200,000. You will notice here, of course, that the $120,000 variable selling and administrative expenses plus the fixed selling and administrative expenses equal that same $320,000 that you see on the full absorption costing side. All right, net income, $580,000 under variable costing, the same as absorption costing. Now, here, the units produced are going to exceed the units sold. So we produced 60,000 pairs, but we've only sold 40,000 pairs. So the income under absorption costing is going to be $320,000. How do we get that? We take the sales, 40,000 times $40, $1.6 million. The cost of goods sold, 40,000 pairs times $25, which is $1 million. So our gross profit is $600,000. We back out the selling and administrative expenses of $280,000, and that gives us an income of $320,000. Now, under variable costing, we have the same sales of 1.6 million, but our variable cost of goods sold is 600,000, not 1 million, and the variable selling and administrative is 80,000, total of 680,000 variable expenses. Our contribution margin, 920,000. The fixed expenses were the 600,000 plus the fixed selling and administrative of 200,000. And that gives us 800,000. We subtract that, and that's 120,000. You can see a dramatic difference in what was reported under variable costing and what would be reported on our financials at $320,000. Now, under the units produced being less than the income sold, we have just the opposite effect. And here we walk through our full absorption costing, sales, cost of goods sold at $25 times 80,000 units, our gross profit of $1.2 million, our selling and administrative expenses $360,000, including 80,000 units times our variable overhead rate of $2 per unit, and that gives us an income of $840,000. Whereas under variable costing, here we have our same sales, but our variable cost of goods sold is based on $15 per unit times 80,000 units, a total of $1.2 million, and then our variable selling and administrative at $160,000, total $1,360,000. So our contribution margin is $1,840,000, and our fixed expenses of $600,000 for fixed overhead and fixed selling and administrative expenses of $200,000, total of $800,000. That gives us an income of $1,040,000. Quite a bit of difference, $200,000 more. All right, so in summarizing income reporting, if production is the same as sales, absorption costing will equal variable costing. But if production exceeds sales, that absorption costing will give us more income than variable costing. And the opposite would be true if production is less than sales, then our absorption costing will reflect more income, as shown in this summary of the 3 years here. Okay. Now, how then does absorption costing result in overproduction? Well, here, if I'm planning production, unit costs under absorption costing, we know these numbers, same numbers as we've been using here. But if I look at fixed overhead here, with 60,000 being produced, that gives me a per unit fixed overhead per unit, I should say, of $10. But if I make 100,000 under absorption costing, that fixed overhead per unit falls to $6 per unit and results in our product cost falling from $25 per unit down to $21 per unit. Okay. Now, if I'm planning production, my income under absorption costing, here we have 60,000 units produced and 60,000 sold. Here we had 100,000 units produced, but only 60,000 sold. Same amount sold, right? So, if we walk through the arithmetic, which I think we've done before, and we look at these numbers, we find that using $21 in cost of goods sold compared to $25 results in a dramatically different cost of goods sold. And of course, a much higher income. That looks like a good place to stop this video. And when we return, we will continue on with income under absorption costing. Until that time, bye for now.